Welcome back. In the last video, we talked about how to find and how to apply a multiple to your business's discretionary earnings in order to find out an approximate value for that business. The multiple of earnings approach is arguably the most meaningful and certainly reliable valuation method, but it isn't the only one that we use. In this video, the fourth in our series on valuing a business, I'm going to go over 3 additional methods that we and many business buyers use to value businesses: multiples of revenue, capitalization of earnings, and debt coverage. Each of these methods have their pluses and their minuses, and in the end, I'll explain why we use them. So let's start with a multiple of revenue. This multiple applies a multiple to sales, but a different multiple than the one we used for earnings. For example, one business might sell for 0.5 times its revenue, while another might sell for 1.2 times its revenue. But none of this tells us anything about earnings, what the business makes. This is a simple approach, which is probably why you hear it bandied about often. The problem is, of course, as I mentioned, revenue tells us nothing about profit, and profit is what buyers are looking for. So 2 companies could have the same revenue numbers, say $3 million each of them, but one might be making $590,000 and one might be making $100,000. And you could see that these earnings vary widely, and so therefore the multiple of revenues approach is only marginally useful in valuing a business. But we use it primarily to underscore and check the accuracy of our multiple of earnings result. This is key. We want to make sure that we have confidence and can justify our valuation, which of course stems from earnings. But this multiple of revenue is a way to do that. Now, though the numbers differ, determining and finding the multiple of revenue is the same as determining and finding the multiple of earnings, and the source is the same. I'll make sure there are links in the description. Now, another method we use, and this is a very good one, though a little bit more technical, and this is what we call a capitalization of earnings. What are those earnings really worth? Now, in this method, we take our discretionary earnings and divide it by the capitalization rate that we establish. The cap rate generally reflects risk, growth potential, and, most important, what the return on the buyer's investment is likely to be if they buy your business. Remember, we discussed rate of return in I think it's the first video of this series, which I'll link in this post. And this is one of the 3 pillars of a business's value. The 3 things that a business has to do for its owner. So if a business generates, for example, $200,000 in earnings, and the appropriate cap rate is, say, 20%, the value of the business would be $1 million. Now, this method is used usually for established company with predictable earnings, but we use it in every valuation because it shows the buyer what the rate of return will be if they buy at the value we establish. This is an extremely important and strong marketing tool. Now, explaining the process of determining a cap rate is beyond the scope of this short video, but we'll be doing a video on capitalization rates over the next couple of weeks, so don't forget to subscribe so you don't miss it. And the final method that I want to discuss today is will the business cover the debt obligation? We call this the debt coverage method. Almost every business that is acquired with financing. And remember that another of the 3 pillars of what a business must do for its owner is that it must pay for itself. Here again, we look at discretionary earnings and compare them to the annual debt service that the company is going to be saddled with. But as we discussed in part 1, before we do that, we have to adjust the discretionary earnings to reflect the first 2 pillars of a business's valuation, what it must do for an owner. Number one, it has to provide a competitive salary. And number two, it has to provide a return on the buyer's investment. The third one is this one. Will it pay for itself? So, as an example, if after making all the adjustments, the business generates, say, $300,000 a year in discretionary earnings, if the loan payments amount to $150,000 a year, that's a 2-time coverage ratio. Really pretty good and very acceptable to most lenders. But if earnings barely cover the debt payments, the business value is likely too high and the deal may just not pencil out. The method is practical. It's a real-world test of whether a buyer, especially one using an SBA financing tool, can actually afford the business. Will the business pay for itself? So where does this leave us? Well, multiples of discretionary earnings are generally the most meaningful indicator of value, and when we value a business, we always give that result the highest weighting in our final calculations. But multiple of revenue, capitalization earnings, and debt coverage all provide additional and important context. They help us cross-check our calculations and make sure our valuation is justifiable and defensible. This is huge. Remember, we have to make it easy for buyers to buy. Showing a buyer the rate of return that they'll receive if they buy this business, the cap rate, and provide the buyer with comfort, make sure that the buyer is comfortable that the business will pay for itself. This will eliminate a great deal of anxiety on the part of the buyer and provides an extremely strong justification for the value that we establish. It gives you a very strong negotiation position. Now, in the next video, the final part of this series, I'll show you how we bring all of these methods together into a comprehensive and supportive estimate of value. Make sure you subscribe so you don't miss that one.